Good morning, students. As you are all aware that we have learned about the chapter income of other persons included in the assess's total income. Now, we've discussed two topics from that chapter in the last class. One is revocable transfer and another is asset transfer to the spouse or for the benefit of spouse to any person or to any transferee without adequate consideration. Now here today we will touch on two more topics that are included in your syllabus. As we can see from the slide that if any asset is transferred by father-in-law or mother-in-law without adequate consideration to son's wife, then whatever income that will be generated from such transferred asset to the transferee will be included or will be clubbed in the hands of the transferor. Right? So it's an easy point. The main stress is to be given to the point that the asset transferred should be without adequate consideration, as we have learned in the last class. Point number 2 says asset transferred invested in the business. Now, if father-in-law or mother-in-law transfers any asset to son's wife without adequate consideration and son's wife in turn invests such asset in a business from which she earns any income, then the proportionate income will be chargeable to tax in the hands of the transferor and the transferee. We've already done a problem on this in our last class. Point number 3 is also the same. We've already discussed this point in the last class, where transfer of assets for the benefit of the spouse, where we've transferred an asset to an association of person or to any person without adequate consideration, and if any income that is generated from such asset to such association of person or to such person or the transferee, as we can say in one word, then if it is for the immediate or deferred benefit of son's wife, then that income will be clubbed in the hands of the transferor. Now let us do a problem and get a clear picture on our concepts. Mrs. Kasturi transferred her immovable property to ABC Company Limited subject to a condition that out of the rental income, a sum of rupees 36,000 per annum shall be utilized for the benefit of her son's wife. So students, can you see that Mrs. Kasturi here has transferred an immovable property to ABC Company Limited. The transferee is ABC Company Limited and the transferor is Mrs. Kasturi, being the mother-in-law. She says that out of the rental income, a sum of rupees 36,000 per annum should be utilized for the benefit of the son's wife. So here we are referring to the point number 3 of our last slide. Mrs. Kasturi claims that the amount of 36,000 utilized by her son's wife should not be included in her total income as she no longer owned the property. Examine with reasons whether the contention of Mrs. Kasturi is valid in law. So here we can clearly understand that the asset that has been transferred to the transferee is for the benefit of son's wife. So whatever the income that will be generated will be clubbed in the hands of the transferor. So this is what the provision of Income Tax Act says. So let us go through the solution what it says. The clubbing provision under section 64(1)(8) are attracted in case of transfer of any asset directly or indirectly otherwise than for adequate consideration to any person to the extent to which the income from such assets is for the immediate or deferred benefit of son's wife. This is what we have learned from the last slide. So this is a provision that is applicable here. So this 36,000 that is being utilized by son's wife for the benefit of son's wife will be clubbed in the hands of Mrs. Kasturi. Okay. So therefore income of 36 36,000 meant for the benefit of daughter-in-law is chargeable to tax in the hands of the transferor. That is Mrs. Kasturi in this case. The contention of Mrs. Kasturi is hence not valid in law. So therefore, whatever Mrs. Kasturi is saying, that no, this 36,000 what has been utilized or what has been used for the benefit of son's wife should not be clubbed in my hands. This will not be the case. The law says that it has to be clubbed in your hands and a tax will be charged on this 36,000 in the hands of Mrs. Kasturi. So we've got a clear picture of our point number 3. The point number 2, in our last slide, we've discussed in our previous topic where asset has been transferred to spouse without adequate consideration. We did a problem on that. You can refer to my last class. Okay. Then I move to the last topic of this chapter. Conversion of self-acquired property into the property of an Hindu family. Hindu undivided family. So we've already done in our previous semesters, as what we known as HUF. It's a Hindu undivided family. So here, the section 64(2) says that if I convert my self-acquired property into the property of an HUF, what will be the clubbing provisions that will be applicable in my case? Okay. It says where an individual who is a member of the HUF converts at any time after 31st December 1969 his individual property into property of the HUF of which he is a member, or throws such property into the common stock of the family, or otherwise transfers such individual property directly or indirectly to the family otherwise than for adequate consideration, the income from such property shall continue to be included in the total income of the individual. That means suppose I am an individual, I have a self-acquired property. Now I am transferring my self-acquired property or I am giving it to the HUF and I am a member of that HUF. So the provision says that if you are transferring, if a self-acquired property is transferred to HUF, is given to the common stock of the HUF without adequate consideration, then in that case, whatever the income that will be generated from such property will be clubbed in my hands and not in the hands of the HUF. Easy? The provision is very, very easy. Okay? The next point says, where the converted property has been partitioned either by way of total or partial partition, the income derived from such converted property as is received by the spouse on partition will be deemed to arise to the spouse from assets transferred indirectly by the individual to the spouse. So whatever the partitioned assets, partitions mean it has been divided into the members of the family of the HUF. So in that case, if my spouse receives any portion of such asset, so whatever the income that will be generated from the partition portion of my wife will be clubbed. My wife, I should not say, it should be spouse, husband or wife. So will be clubbed in the hands of the transferor. Now the next point says, where income from the converted property is included in the total income of an individual under section 64(2), it will be excluded from the total income of the family or, as the case may be, of the spouse of the individual. It says that if any income that has been included, if the clubbing provisions are applicable and that income has been included in the hands of any individual of the HUF, any member of the HUF, then the HUF will not have to pay tax, or that income will not be considered while calculating the total income of the HUF. So it has to be mutually exclusive. If it is getting taxable in the hands of the individual members of the HUF, then it will be taxed there and it will not be taxed under the HUF. If it's getting taxed under the HUF, it will not be getting taxed in the individual hands of the members of the family. So these are the topics that are there in this chapter. So we've completed the few provisions that were relevant for you. In this online class, it is very difficult to go through all the small provisions or the integrities of law. We have a question answer and a query session later. So if you have any problem in this chapter, we can discuss at that time. As of now, students, thank you very much.